You have spent your entire life believing in the greenback. You were taught that the US dollar was as solid as the ground beneath your feet. For decades, the dollar was the world's undisputed anchor, the safe haven for every retirement account and every pension fund in America. It was the currency that rebuilt Europe after the war, the currency that fueled the global digital revolution, and the currency that guaranteed the American way of life. But while we were watching the headlines about domestic politics and celebrity drama, the very foundations of that anchor were being quietly, systematically eroded. Right now, a financial fortress is being built right here in the Western Hemisphere, just a few hundred miles from our borders. It is a fortress that doesn't use bricks, mortar, or barbed wire. Instead, it is built on digital ledgers, complex currency swap agreements, and state-backed clearinghouses. Beijing has realized a terrifying truth. They don't need to defeat America on a conventional battlefield if they can simply make the dollar irrelevant in our own backyard. This is the story of the financial backdoor, a long-term, strategic move to de-dollarize Latin America and create a parallel economic reality that functions entirely outside of Washington's reach. Today, we are going to look at why our long-term neighbors are walking away from the dollar, how China is providing a seamless alternative, and what this means for your savings and the future of your children. Welcome back to the channel. We are going to dive deep into the hard numbers, the secret central bank agreements, and the shifting power dynamics that the political elite in Washington are desperate to ignore. This is not just a lecture on global finance, it is a warning about the value of the money sitting in your pocket right now. The weaponization of the greenback. To understand why China is winning this financial war in Latin America, we first have to understand why we are losing our traditional allies. For the last 80 years, the US dollar has enjoyed what economists call exorbitant privilege. It gave Washington immense power to set the rules of global trade and enforce its will through financial sanctions. But in recent years, Washington began to use that power not as a tool for stability, but as a heavy-handed weapon. We saw it with the freezing of hundreds of billions in foreign reserves and the sudden expulsion of entire nations from the SWIFT payment system. To the planners in D.C., this seemed like a powerful way to enforce American foreign policy without putting boots on the ground. But to the rest of the world, especially in the growing economies of the global South, it was a loud and clear warning. It told every sovereign nation that if they ever disagreed with Washington's specific agenda, their entire national treasury could be turned off overnight. For leaders in Mexico, Brazil, and Argentina, the dollar stopped looking like a stable, neutral asset and started looking like a geopolitical liability. They realized that being tied to the dollar meant being tied to the whims of the U.S. State Department. China saw this creeping fear and moved in with a calculated solution. They didn't come with threats of invasion or ideological lectures about democracy. They came with a parallel financial architecture that promised autonomy. They offered a way for these nations to trade, grow, and survive without needing a green light from the New York Federal Reserve. This is the first brick in the new financial fortress, the total death of trust in the old US-led global system. When trust is gone, the currency is just paper, and Beijing is ready with a digital alternative. Yuan Bridge, Mexico's hidden swaps. When we talk about Mexico, the conversation is usually about the border, migration, or the trade in physical goods like cars and corn. But the most dangerous movement is happening in the invisible world of currency swaps. To put it simply for those of us who aren't Wall Street bankers, a currency swap is a secret agreement between two central banks to trade their currencies directly. In the old world, the dollar was the mandatory middleman. If a Mexican company wanted to buy high-tech components from a factory in Shenzhen, they first had to sell their pesos for US dollars. Then they had to trade those dollars for Chinese yuan. This process meant that every single transaction paid a tax in the form of fees to American banks. More importantly, it meant that every single transaction was visible to the American government's monitoring systems. Beijing is now building a direct bridge that bypasses the American middleman entirely. They are setting up massive multi-billion-dollar swap lines that allow Mexican and Chinese firms to trade directly, peso to yuan. This might sound like boring accounting, but it is actually a strategic earthquake. By removing the dollar from the equation, China is insulating the entire Mexican economy from any potential American financial sanctions. They are creating what we call a dark pool of trade, a massive flow of capital that Washington can neither see, tax, nor control. In the years 2024 and 2025, the volume of these direct, non-dollar trades has absolutely skyrocketed. Major Mexican industrial groups, especially those in the manufacturing and energy sectors, are now keeping a significant portion of their reserves in yuan. They aren't doing this because they love the Chinese Communist Party. They are doing it out of a cold desire for survival. They are building a financial insurance policy against the day when the U.S. might try to weaponize the peso in a trade dispute. The bridge is built, the traffic is flowing, and Washington is standing on the sidelines with no way to stop it. Commodities without dollars: oil, SOI, and lithium. The true global power of the U.S. dollar has always been its ironclad link to the world's most vital resources. Since the mid-1970s, the petrodollar system ensured that oil was traded almost exclusively in dollars. This forced every country on Earth to hold massive piles of greenbacks just to keep their power grids running and their cars on the road. But that system, which has lasted for 50 years, is cracking right before our eyes in our own hemisphere. Look at the case of Brazil, the largest and most influential economy in South America. In late 2023 and throughout 2024, Brazil and China signed landmark agreements to settle their massive trade in iron ore, soy, and oil in their own local currencies. Think about the scale of that. The world's largest consumer of soy and the world's largest producer are now trading without touching a single U.S. dollar. This was a direct, devastating blow to the dollar's dominance in the global commodity markets. But it's not just about the crops, it's about the future of energy itself. Consider the Lithium Triangle in the high Andes of Argentina, Bolivia, and Chile. This region holds the vast majority of the world's white gold, the lithium required for the global electric vehicle revolution. Chinese state-owned companies are now the primary, aggressive investors in these mines. And they are not paying for these resources in dollars. They are establishing 30-year supply contracts settled entirely in yuan. This ensures that the massive energy transition of the 21st century will be fueled by a financial system that Beijing controls. For a farmer in Iowa or a rancher in the Texas Panhandle, this might feel like a distant problem, but you have to understand the mechanics of value. If the rest of the world no longer needs US dollars to buy the oil they burn or the lithium they use in their batteries, the global demand for our currency will plummet. And when global demand drops, the value of every dollar you have worked 40 years to save begins to melt away through inflation. This is the commodity trap. China is locking up the world's future resources using a currency that they print and they regulate, leaving us out in the cold. The cross-border interbank payment system, CIPS. For nearly half a century, the world's financial system had no choice but to use SWIFT. SWIFT is the Belgian-based messaging system that connects over 11,000 banks across the world. It was the essential plumbing of global finance, and for decades, Washington held the keys to all the valves. If your nation was kicked off SWIFT, you were effectively banished from the civilized world. But China has spent the last 10 years building its own plumbing, and it is now fully operational. It is called CIPS, the Cross-Border Interbank Payment System. Unlike SWIFT, which is just a messaging service, CIPS is a full-scale clearinghouse and settlement system for the Chinese yuan. It is designed to be faster, it is significantly cheaper, and most importantly, it is completely invisible to U.S. Treasury regulators. In 2025, we are seeing a record-breaking number of Latin American regional banks joining the CIPS network. Why are they doing this? Because they want a plan B. They saw what happened to other nations in recent years, and they refuse to be the next ones caught in the crosshairs of a DC political dispute. By joining CIPS, these banks are plugging into a global financial grid that bypasses the New York and London banking hubs entirely. This is the new digital Silk Road. It is a shadow financial system that is growing every single day, expanding right under the nose of our intelligence agencies. Once a country's entire banking sector is integrated into CIPS, the threat of U.S. financial sanctions becomes a toothless tiger. We are losing our most powerful non-military weapon, the ability to cut off funding, and we are losing it in our own neighborhood. Beijing isn't just offering a new bank, they are offering an escape hatch from American power. The impact on your savings and retirement. Now let's bring this conversation home to the kitchen table in the heartland. Why should a retired factory worker in Ohio or a small business owner in Nebraska care about digital ledgers in Mexico City or soy trades in Brazil? Because the exorbitant privilege of the US dollar is the only reason our government can run $34 trillion in debt without immediate catastrophe. As long as the rest of the world is forced to hold our debt to conduct their trade, we can keep printing money to pay for our government programs. But as the Mexico backdoor and this financial fortress expand, that privilege is rapidly disappearing. When nations in our own hemisphere stop needing dollars to buy their food and energy, those trillions of dollars start to flow back to our shores. This is the hidden, structural driver of the inflation we have been seeing at the local grocery store, in the corner gas station. It is not just about temporary supply chain issues, it is about a global surplus of dollars that the rest of the world simply doesn't want anymore. If the dollar loses its status as the world's undisputed reserve currency, the cost of every single thing we import will skyrocket. Your pension, which seemed like more than enough 5 or 10 years ago, may only buy half as much in the near future. The value of your 401k and your hard-earned savings is directly tied to the global strength and demand for our currency. If the foundations of that currency are being bypassed by a Chinese-controlled system in Mexico and South America, your financial security is being traded away. This is the de-dollarization tax that every American family is already starting to pay. We are watching a slow-motion collapse of our monetary hegemony, and the impact will be felt in every rural town and every suburban neighborhood across this country. Inflation isn't just a number on the news. It is the sound of your purchasing power being transferred to the new financial masters in the East. Washington's financial panic and the doom loop. The senior leadership in Washington and at the Federal Reserve is finally beginning to realize that the sanctions strategy has backfired in a spectacular way. They thought they could use the dollar to police the world and force every nation to fall in line with American interests. But instead, they have provided the ultimate incentive for the world to build a life without the dollar. There is a quiet, desperate panic in the halls of the Treasury Department right now. They are seeing the internal reports of massive gold buying by central banks across the global south. They are seeing the classified cables about secret currency agreements between Beijing and our closest neighbors. But Washington is now stuck in what economists call a financial doom loop. If the Fed raises interest rates too high to save the value of the dollar, they risk crashing our own economy and making our interest payments on the national debt completely unpayable. But if they keep rates low to stimulate growth, they allow inflation to continue destroying the currency from within. We are seeing a desperate late-stage attempt to regain some form of control. Washington is now proposing new financial stability annexes for the USMCA, trying to force Mexico to limit its use of the Chinese CIPS system. But many analysts believe this is a case of too little, too late. The trust has been shattered, the technology has been deployed, and the alternative system is already up and running with millions of transactions. China is not just offering a different set of bills and coins, they are offering a different vision of the world order. A vision where no single nation, no matter how powerful, can pull the plug on your national economy. In a world full of geopolitical uncertainty, that is a very tempting offer for our neighbors, and it is an offer that Washington has no answer for. The new monetary reality. We are living through what will be remembered as one of the greatest shifts in human history. For 80 years, we lived in the age of the dollar, an era of unprecedented American influence and relative financial stability for our citizens. But that age is coming to a close, and it is being replaced by a fragmented, multipolar, and multi-currency world. The financial fortress that China is building right here in the Americas is a reality that we can no longer afford to ignore or dismiss as a conspiracy. It is time for us to stop looking at the world as it was in 1995 or even 2015, and start seeing it as it truly is in the final months of 2025. We have to ask ourselves the hard questions. How do we protect our families and our communities in a world where the dollar is no longer the undisputed king? How do we ensure that our retirement is secure when the very currency it's built on is under assault in our own backyard? We have to demand that our leaders stop using our currency as a political toy for overseas adventures and start treating it as the sacred trust that it is. I want to hear from you because this affects your life more than almost any other issue. Are you worried about the value of the dollar over the next 5 to 10 years? Have you started to look at diversifying your own savings into hard assets, precious metals, or other forms of value that aren't tied to the digital ledger? Do you think Washington has the courage to save the dollar, or has the damage to the world's trust already been done? Let me know your thoughts in the comments below. I read them all, and your insights are what drive this community forward. If you found this analysis important, please share it with your friends, your family, and your neighbors. Most people are distracted by the noise on television and have no idea that the real threat is in the very bank accounts they rely on every day. Make sure you are subscribed to our Substack for our exclusive, detailed reports on how to navigate this new monetary reality and protect your assets. I will be continuing this discussion in a specialized deep dive over on Patreon, where we will look at the specific historical assets that have held their value when reserve currencies have failed in the past. Thank you for your time, your trust, and for being an essential part of this community of truth seekers. The world is changing faster than ever, but together we can stay informed, stay prepared, and stay strong. Stay vigilant, stay informed, and I will see you back here tomorrow. Bye for now.